What's up guys, Bill here, and in this video I'm going to talk about IV flushes. This is a topic that there's a lot of videos on YouTube, and so I'm not going to spend a ton of time talking about it, but it is earnings season again, and today we had a great example of an earnings flush play, which was Netflix, okay? So just looking at some of the basic stuff, if you guys have never done this type of play and you're kind of interested in learning the basics, what you want to know is IV means implied volatility. And every stock kind of has their average implied volatility on a week-to-week basis, but ahead of certain types of events, especially like binary events like earnings or FMOC, things like this, that IV will increase because those type of events tend to bring in buyers and people are expecting some type of big move in either direction. So the contract prices go up and up. People keep buying on both sides. And this is where the volatility comes from. So how do you calculate this and how do you kind of get a better understanding of it? What you want to do is you want to look at the percentage of the implied volatility and you divide it by 16. And what that's going to do is tell you what percentage on the stock can be expected as a move in either direction by the time that that contract expires. So let's look at Netflix, okay? It had earnings after hours yesterday, and we can see now that this implied volatility is around 70. That's about average for Netflix, I believe. But at the end of the day yesterday, it was 160, 170. If I remember correctly, it was really elevated, over double its average, okay? So what happens? If you see the implied volatility on this stock is sitting down here, and let's say it's 160, right? So you divide that by 16 and it's 10. That means you can expect about a 10% move in either direction on Netflix. Anything under 10 would mean that this contract's price did not live up to the expectations, and therefore it's going to start to lose its value the next trading day, all right? Especially the further out of the money you get, the further away from where the price ends up. Now, we can see that Netflix had a great move, I believe around 13 or 14%, and it kind of topped out here at my fib around 275. So knowing that a lot of these contracts actually exceeded their expectations all the way up to the 275 chains, how do you want to play this? Well, you're going to start to look at some of these contracts that were up even higher. Let's focus on 300. It's a nice round number. We're nowhere near 300, even though we got this huge move, and the IV on the 300s was, like 170%. So what we're looking for is to take a trade off the open and probably calls, because look at how strong it was, and it held up through most of pre-market. So obviously people liked the earnings report. They wanted to buy Netflix, but we're going to get Netflix at a very cheap price compared to what we would have had to pay at the end of the day on Tuesday before earnings came out. And let me show you how this worked. We can see that in pre-market it's kind of pulling, and there was a little pull off open before a nice move up. This is the 15-minute chart. So you won't see as much of the dip, but it was, a pretty good dip. Let's look at the 300 contracts. So this was the end of the day yesterday. The IV was increasing. People kept buying, and it closed around 150. Look where it opened. Now remember, Netflix had a great earnings. They went up 13%. But these were so far out of the money, 300. Look where they opened, 90. All right, so you've already saved yourself 60 bucks on these contracts if you just wanted to buy off the open. But if you're even more patient, look at this. We get a move all the way down, and you could have bought for 40. It's hard to snipe the exact bottom, but you can see my point. You're looking to buy calls around here at a huge discount from 150 down to say 50 or 40, right? Huge discount. And you're thinking, okay, you know, people are taking profits, plus the IV is going to decrease. You know, so look at the IV now. It's 75. It was over 170. So, you know, the IV took a 60% hit. These contracts took a way more than a 60% hit. You buy down here, you buy your calls, and you think, okay, well, you know, once everyone takes their profits and the IV kind of settles and the contract prices pull back a little bit, you take your calls, and this is great risk reward. Because look at this. The low on the first 15 minutes, I mean, hours later it took to come back down here. So you buy calls anywhere around here and hold for even just 15 to 30 minutes, and you're buying, you know, from 45 up to almost 200. Think of the gains there in quick gains, right? So this is the power of the IV flush. You don't have to start buying things before earnings and trying to pick the right side and doing all this and stressing it. Even a successful earnings, you can lose money like you would have if you bought 300 calls. You would have been read it open. Don't be that guy. Wait. Watch for the IV flush. Take your position and sell into this momentum. All right? If you have any questions about IV flushes, just hit me up on Twitter, YouTube, any place like that in the Discord, and I'll help you out. Thanks, guys.